Okay, I think we'll get started and just have the few stragglers come in and sit down. Well, good morning. I'm Marv Fertel, and I'm the President and Chief Executive Officer of the Nuclear Energy Institute, and I want to thank all of you for coming here this morning, and we're pleased. We've done this in the past. Sometimes we ended up with snowstorms, and when I came in over the weekend, they were forecasting snow for Thursday, so we were pleased we didn't get snow today, and everybody could come and have a nice breakfast and hear our story. Our theme this year is discipline pays dividends, and those three words capture the approach to our business and the basis for our continued success. As you know, we take a disciplined approach to operating nuclear energy facilities, and we're taking an equally disciplined approach to new nuclear plant development. At our 104 operating plants, supplier facilities, and construction sites, the men and women in our industry are focused on safety, precise about following procedures, and always vigilant and conservative when operating, maintaining, or building nuclear facilities in the U.S. or abroad. The sum total of their individual actions allows the nuclear industry to achieve very high levels of safe and reliable operation and to maintain them year after year. Today's briefing will start with a review of the operations at U.S. nuclear energy facilities. We've had another really good year of solid performance. Next, we'll update you on the progress towards building new nuclear plants. And for this segment, we'll turn to the two companies that are furthest along. Jim Miller, President and Chief Executive Officer of Southern Nuclear Operating Company, and Steve Byrne, Executive Vice President of Generation and Transmission and Chief Operating Officer of South Carolina Electric and Gas, will provide an update on their projects. And I think you'll see we're actually really building in our country today. And then finally, we'll close with a policy outlook. When people discuss the resurgence of nuclear energy in the United States, they tend to start with the 2005 Energy Policy Act or the 2009 climate change legislation. These events certainly accelerated interest in new nuclear plant development, but the resurgence actually started back in the early 1990s. Primarily due to improvements in operation and power uprates implemented since the early 1990s, the industry has added the equivalent of 29 new 1,000 megawatt generating plants to our grid, and has done that while achieving excellent levels of safety. Safety is and always will be our highest priority. We have a self-interest in safe operations. We preserve and enhance the asset value of 104 operating plants first and foremost by maintaining focus on safety. Safety is the basis for regulatory confidence and for political and public support of this technology. Safe and reliable operation of our existing plants is the platform from which we can launch the next generation of nuclear energy in this country. This seems to be well recognized. In fact, the President's Oil Spill Commission identified the Institute of Nuclear Power Operations as the model for self-regulation by the offshore oil and gas industry. Safety, reliability, and high levels of productivity go hand in hand. Looking back over the last decade, U.S. nuclear plants have achieved consistently high outputs and capacity factors. Industry performance for 2010 continued this trend with an average capacity factor of about 91% and output of more than 800 billion kilowatt hours. Refueling outages, another measure of management effectiveness, remains consistently in the 40-day range, which is outstanding given that many plants are undertaking major modifications, capacity uprates, steam generator, and vessel head replacements. And you remember that refueling outages averaged about 90 days in the early 1990s. The nuclear industry operates with long-term horizons. You see this and proof of this on the slide that we have up right now. We continue to invest in our operating plants to increase their capacity through power uprates and to equip them for safe, reliable operation beyond the initial 40-year license term. Industry-wide, we invested approximately $6.5 billion in 2009 to replace steam generators, reactor vessel heads, and the equipment modifications necessary to uprate the plants and in other capital projects. As the last of these major modifications are implemented, we anticipate capital needs will gradually decrease over the next few years. The NRC has approved an additional 20 years of operation for 61 reactors with another 21 applications pending. We're in the process of defining the requirements for a second renewal period that could allow operation beyond 60 years, from 60 to 80. Power uprates increase capacity from existing plants. More than 5,000 megawatts of uprates have been implemented, and another 3,000 megawatts are slated for NRC review by 2014. With NRC approval in hand, completion of uprates is timed to match increasing electricity demand or to replace generation from retirements or other power plants. Our investments in equipment complement our commitment to continuously invest in people. The industry is required to provide ongoing training to all engineering, maintenance, and operations personnel. We also support partnerships with more than 40 community colleges and 30 nuclear engineering programs to educate the next generation of workers. New workers are needed to support replacements for retiring workers. We have a large bow wave coming, and upcoming expansions like the completion of Watts Bar Unit 2 and construction of new reactors. After having refurbished and restarted Unit 1 at its Browns Ferry Station in 2005, a $1.8 billion project that was brought in on time and within 5% of the original cost estimate, the Tennessee Valley Authority is now completing Unit 2 at its Watts Bar Station. This is a $2.5 billion project, currently on budget and on schedule for full power operation in October 2012. 90% of the engineering and 64% of the construction are complete, and we have 3,500 people working at the site. The project management tools and culture of continuous improvement that have improved operations are being implemented successfully for construction projects to provide predictability in both schedule and budget. Let's turn now to new nuclear plant development, and let me again provide some context around this subject. For several years now, we've urged the media, federal and state policymakers, and the financial community, and others, to have realistic expectations about new reactor development. We've said that so-called nuclear renaissance in the United States would unfold rather slowly. We've told you that we expect 4 to 8 new reactors online in the 2016 to 2020 timeframe. We still believe that. We've all known that the pace of new nuclear plant development depends on many factors, including forward prices for electricity and natural gas, capital costs for all baseload electric technologies, commodity costs, growth in electricity demand, availability of federal and state support for financing and investment recovery, and environmental compliance costs for fossil fuel generating capacity. This has been our story for 5 years now, and we're going to continue to tell it to you because we believe it's correct. So today, demand is off as our nation struggles out of its recession. Many power markets are oversupplied. Natural gas and power price futures continue to decline. I said earlier that we take a long-term view, as we must when building and operating plants that will provide electricity for 40 to 60 years, and we actually don't believe that the long-term fundamentals have changed. Yes, the price of gas is low, but we've seen 4 major periods of volatility in gas prices since 2000. At no time during that period did we have any concern about gas supply or resource base. So at least in the past, gas price volatility has not been correlated to resource base. Maybe more importantly, there's the age of our existing capital stock. The U.S. has roughly 1,000 gigawatts, 1 million megawatts of electric generating capacity. 280 gigawatts are 30 to 40 years old. 140 gigawatts are over 40 years old. And the oldest capacity is coal, oil, or gas steam-fired capacity, relatively inefficient and much of it not equipped with state-of-the-art environmental controls. In a recent analysis by the Brattle Group, they estimate 50 to 65 megawatts of coal-fired retirements by 2020. Some nuclear plants may retire in the next few decades too. Whatever the number, that capacity must be replaced. And finally, of course, we must build to meet new demand for electricity. The Energy Information Administration assumes only 1% annual growth in electricity demand in its latest forecast, well below historical trends. But even that produces a need for 220 gigawatts of new electric generating capacity by 2035. Currently, there are 12 applications for a combined construction and operating license under active review at the NRC, plus 2 applications for early site permits. These are in addition to the 4 early site permits that NRC has already issued. The first COL should be granted to the Vogtle project this year, and 3 reactor designs are expected to be certified this year. Where business conditions justify, as you'll hear, our companies are moving forward with construction activities. Others are completing the necessary upfront licensing work so that they're in a position to start construction when markets improve and business conditions justify. As I said, the long-term fundamentals still represent a solid business case for new nuclear plant development. The near-term market fundamentals are clearly more challenging, and the pace of new plant construction for many companies depends directly on availability of financial support. That can come either from the federal government through the Loan Guarantee Program, created by the 2005 Energy Policy Act, or from state governments in the form of supportive regulatory treatment. Workable implementation of the loan guarantee program continues to be a struggle. For nuclear power projects, only the Vogtle project has a conditional commitment, which is for up to $8.3 billion. This leaves $10.2 billion of funding available for other projects. We will need additional loan volume to support the 3 projects still in some stage of due diligence: Scanners Summer 2 and 3, expansion, and the 2 merchant projects, Calvert Cliffs 3 and South Texas 3 and 4. The administration requested $36 billion in additional loan volume for 2011, but Congress adjourned without having passed any appropriation bills. Even though nuclear loan guarantees are actually a revenue generator for the government, and while we expect to be successful in getting additional loan volume, we know it may be difficult to obtain in a new Congress that is dedicated to cutting the federal budget and reducing the deficit. Access to this program at a reasonable price is also essential, and we are focused on correcting the methodology and assumptions used by the executive branch to calculate the credit subsidy fee that project sponsors must pay. The assumptions are unrealistic, and the process yields inappropriately high fees. We saw this last September when Constellation Energy withdrew from the Calvert Cliffs 3 project after having been quoted a loan guarantee fee of over $800 million, or about 11.6% of the face value of the loan. The model used by the government to calculate credit subsidy fee is highly sensitive to input assumptions about recoveries in the event of default. It is our understanding that the executive branch employs a recovery rate of 55% across the board for all energy technologies and projects being considered for Title 17 loan guarantees. The 55% recovery rate is an arbitrary number and has no basis in actual market experience with financial structures like those being proposed by nuclear projects. It is significantly lower than the recovery rates observed historically for regulated utility debt and project finance debt. We know from our own modeling that realistic recovery rates would produce reasonable subsidy costs. We are cautiously optimistic that we will be able to resolve these issues given the White House support for this program. The 2 projects that are moving forward are in regulated states and have earned strong state support, including the ability to recover financing costs during construction, assurances that they can recover development costs as incurred, and that expenditures will be recoverable even if a project is later canceled. The first concept, construction work in progress, significantly improves cash flow during construction when stress on cash flow is greatest. Supportive legislation is being successfully implemented in Florida, Georgia, and South Carolina. As a result, project development is underway in all 3 states. Let me turn the podium over to Steve Byrne and Jim Miller so that they can give you an update on new plant reactor projects in South Carolina and Georgia, respectively. Here's Steve Byrne to tell you more about South Carolina.